Hello, this is James Robinson with the Extrinsic Value blog, and today we're going to talk about our results from June of 2018. So in the month of June, the market was up marginally. We were also up and in fact did manage to outperform the S&P 500 once again. The fund's value started the month at $9.97 per share, and we ended the month at $10.17 per share, which is up 2.02%. And more importantly, that number brought us profitable for the year. I'm going to do another blog in the next week or two talking about how I came up with the fund and the valuation for the fund and why I'm quoting $10 a share as the initial point. I'll explain all of that in another blog. But for now, let's just assume that I am profitable for the month. So that the month's profits had changed my total performance for the year since January 1 to up 1.7% from negative 0.03% as of the end of May, I should say. My annual rate of return annualized now is 4.12%. While it's nothing to write home about, it's much better than running a loss. For the month, I went from 87% invested in stocks to 92.78% invested in stocks. Last month, we converted 2 stocks from temporary to long-term and bought 2 new companies, threw a little bit more money at those companies, and we also doubled down our investment in H&R Block when its stock lost 20% in a single day. We'll talk more about that later. In terms of performance against the benchmark, the S&P 500 was up 0.48% for the month, so we handily beat the benchmark. For the year, the S&P 500 is up 0.84%, so we're now beating the S&P 500 by just under 1% rather for the year. This month, we were able to convert 2 stocks from short-term to long-term holds. As you know from previous blogs, I try and find companies that are undervalued. I buy them. When they've gone up 15%, I sell my original position, and keep the balance in the stock as a long-term hold. In that way, I'm able to maintain a portfolio of stocks that we've made money on and continue to look for underperforming companies. So the 2 stocks which had gone up 15% since we bought them was Wilson Sonoma. We'd owned that stock for 259 days. And so over that time, it went up 15%, and that's a compounding rate of return, including dividends, of about 26.5%. Eagle Pharmaceuticals, same thing. We owned it for 146 days, and including dividends, which there weren't any, the annualized rate of return is 46.54%. So both of those stocks then turned out to have been very good investments, and we'll continue to keep the profits from those stocks in our long-term investment going forward. So since we sold 2 stocks, we had money and room for 2 more stocks. As you know, I like to own 15 stocks in the portfolio. So the 2 new stocks we bought were United States Lime and Minerals and Altria. And so you can see the stats there of what price we bought them and at what price we expect to sell them. So position reports. We've added 2 new stocks to the portfolio. So here's the updated list of the companies that we own in our active portfolio and how much we own. You can see there's 15 stocks. They total about 89.9% of the value of the fund. The balance of the 10% being in long-term holds. That's companies that had gone up and we sold but kept a sliver of the profits. You can see that our largest position is H&R Block. Again, as we mentioned earlier, H&R Block's a solid company. They've been around for a very long time. I really like the financials. I really like the management. The stock plummeted 20% in one day when they announced they were shutting 400 stores and that they felt that perhaps people wouldn't need their services as much due to Trump's new tax plan. I think that's balderdash. I think they absolutely will continue to use them. And 400 stores seems like a lot until you realize they have 11,000. Frankly, I'd say if they weren't closing 400 stores a quarter, they probably aren't doing a very good job of managing a portfolio of real estate. So I doubled down on the stock, and we'll see if I'm right. We added, again, 2 new stocks to the long-term position holds. Here's what those stocks are. And you can see that none of those stocks is very big. The largest position is 1%. And those total stocks combine to 10% of the fund. So again, I never even look at these stocks. I bought them, I made money on them, I've reinvested some of the profits, and I just want to hold them, for a very long time and see which stocks are able to really outperform the market. And if I get dinged on a few of them, I'm not really that worried about it. Because again, these are just very long-term holds for me. So the cash report, over the course of the month, we didn't add any money to the portfolio. The number of shares we owned stayed constant. 5 stocks paid a dividend in the month, but the amounts they paid were very, very de minimis, about 0.14% of the value of the fund. So basically the cash on hand remained constant. My goal is to be 100% invested in stocks. Currently, we're about 7.3% invested in cash, and the balance being in stocks. As we talked about every month, I don't think buying and selling stocks is what I do. I think what I do is research companies and try and identify undervalued companies that we can own. And so in that process, I try and look at 3 stocks per day. And again, I know that doesn't seem like I'm spending very much time on these stocks, but something like 95% of the stocks I buy are not really legitimate candidates for me to purchase. Something like 95% of the stocks that I look at are not really legitimate stocks for me to purchase. 80% of the stocks we look at, almost with a very cursory review of their financials, are not attractive, and the remaining 20% that do seem to have very strong, solid financials tend to be overpriced and thus are able to be overlooked until their price drops. But again, for the month, we looked at 86 companies, which is just over 3 per day. We found 19 companies that I would buy if the price was right. That's about 22% of the companies we looked at. And of those 19 companies, 3 were also cheap enough to be interesting to buy. So for the year, 43 weeks so far this year, we have analyzed, 43 weeks since I started analyzing companies, not since January. Since then, we've analyzed 866 companies. That works out to 2.87 companies per day, so just below my goal. 161 of those companies were found to be solid companies. That's companies that I would buy if the price was right. About 18.2% of the total companies looked at. And of those, 36 as of today are cheap enough to consider buying at today's prices. That means that they're cheap enough. I still would do more research before I bought any one of them. As it stands today, about 4.2% of the companies researched are attractive in terms of fundamentals and price. And that number seems to be pretty constant week in and week out. So, summary. We have our investment was up 2.02% for the month. We outperformed the S&P 500 by 1.5%. 2 companies passed the 15% appreciation threshold and became long-term investments. 2 new companies were added, giving me 15 stocks in the active fund. Cash was reduced to 7.22% due to the doubling of the stock position and slightly increasing our investments in the 2 new stocks. We researched 86 companies, found 19 to be solid, and we found, this says 2, but we actually found 3 companies cheap enough to consider investing in. That's the report for June of 2018. Thank you very much for your time.